Good afternoon, everyone. Thank you so much for coming to our winter session webinar today. My name is Ty Robinson. I am a community engagement specialist here at the Harvard University Employees Credit Union. Today we have a wonderful guest, Shahar Ziv, who's going to be doing a Investing 101 session for you all. Couple things before we start, though. We're going to talk about some housekeeping Zoom stuff. I'm sure everyone here already knows everything about Zoom. It's very prevalent in all of our lives at this point. But how we're going to do today's webinar is all of you are automatically muted, so don't worry about making any sound or anything like that. Feel free to have your lunch, enjoy. We're going to use the Q&A feature on Zoom today rather than the chat if you have any questions or anything like that. This is going to help us kind of like gather everything together and answer things in a little bit more of a timely manner. And then the one thing I did just want to mention as well is that we automatically record all of our webinars here at HUECU, and they're all available for free on our YouTube page for either rewatching or if there's another topic you're interested in. We have hundreds of videos on there, so please stop by and we'd love to have you. If you want to head over to that. Thank you. So a little bit about the credit union. We here are a not-for-profit organization. This makes us different from a lot of the larger banks because all of our members are actually partial owners in the credit union. And this lets us pass on a lot of savings directly to our members, such as we have a lot of lower fees, waived fees, better rates on a lot of products. We also try to have a very direct hand in our community, as well as a lot of like giving back, a lot of donations and things like that. We try our best to make sure that we are listening to our members, listening to our community, and finding as many ways as we can to give back to both the members and the community at whole. So if you're not a member yet, I definitely recommend you stop by and learn more about us. We have our main branch right here in Harvard Square, and it's great. And just in case all of you didn't know, all Harvard students are eligible to open an account here at the Harvard Credit Union. And there are a couple of great benefits that come with that, which you can learn about later, but there's a lot of free fees, things like that. And just in case everybody also doesn't know, once you are a member here at the credit union, you are a member for life. So even if you decide to close your accounts for a while, you can always come back later, open up some different products. And this benefit also does extend to your family as well. So anyone in your family, once you're a member, will be eligible to come in, open accounts, check it out. So we have a lot of great stuff on that. You can check it out later. There's links in the chat to our webpage and everything. But for now, let's get into the presentation. So I'm going to introduce our presenter today, Shahar Ziv. He is the co-founder of the Harvard Personal Financial Management Winter Session course, and is thrilled to be back to teach the program for the 13th year. He is a graduate of Cornell and Harvard Business School and currently works at PayPal as the Vice President of Enterprise Services, Product, and Strategy. He is a contributing writer for Forbes and serves on the board of directors here at the Harvard University Employees Credit Union. So we got some social handles there, but Shahar, take it away.
Awesome. Thank you so much. And hi, everyone. Thank you for joining on this very cold day. I echo, obviously the benefits of the credit union. I serve on the board. Would definitely encourage you to check out the main branch. Maybe not this week when it's in the 20s, but this weekend or next week when it's a little bit warmer would be great. So I'm going to spend the next, I would say 55 minutes talking about how you build wealth and really use that as an intro to investing. And we'll go through, and obviously feel free to put questions in, in the Q&A feature. There's, I know, a webinar right after this, or in about 30 minutes, that we'll be able to kind of address those in more detail. And I also put my email on the screen in case you want to reach out to me with questions as well. So first question, and what I want to start a little bit just more detail, just to give you some background, is, why should you even be listening to me when it comes to investing? So one, I'm really, really passionate about personal finance. As was mentioned, I co-founded this course about 13 years ago when I was across the river at the business school. Have been coming back physically and or virtually since then to teach it. And I actually do this at a lot of other universities, a lot of other employers. So something that I'm really passionate about, and I think is really important to do. I love to teach this. I love to write about it. I love to speak about it. But the most important is at the bottom, which is I am as objective as you're going to find when it comes to delivery of this type of information. I'm not an investment manager. I'm not trying to solicit you to manage your investments. I'm not trying to get you to give me money to invest or to do anything. I'm not going to recommend any company or service that I get compensation for. In short, I don't have any conflicts of interest that should lead you to question my advice. And one, I'm really proud of that. It's something that's really important to me. And it's actually the first lesson I want to impart on all of you, which is, right now you are in the academic bubble. And the vast majority, if not all of the people that you're interacting with within the university, most likely have your best interests at heart. When you leave that bubble, there are a lot of really, really good people who will try to help you, but there's also some who may not have, your best intentions at heart. And so, especially when it comes to money, especially when it comes to investing, you always need to ask yourself, is this person objective? Do they have any conflicts of interest? Do I need to take their advice with a grain of salt? And, kind of ask yourself that, before you're really listening to folks. So hopefully I made a case for why you should listen to me, but it really is that first lesson when you're thinking about getting any type of financial advice, especially when it comes to investing. So just to set expectations about today, we have an hour, and you may or may not know one or both of the people on the screen. So it's Warren Buffett on the left and Mellody Hobson on the right. Warren Buffett, of course, the head of Berkshire Hathaway. Mellody Hobson is the CEO of Ariel Investments. These are two of the most successful investment managers of our time. In 55 minutes, I can't turn you into either of them. I wish I could, but not going to happen. We could probably spend an entire semester, or frankly, an entire year on investing just to get up to speed. Really, the goal of today is to start building your financial and investing toolkit. So we'll talk a little bit about facts, but I also want to give you insights and strategies, which even if you don't understand the underlying technical, kind of pieces of investing, like you can actually just apply in your life. And will get you probably 80 to 90% of the way there. So I know sometimes in your classes, you work to kind of get to the answer at the end of the class or at the end of the semester. I'm going to flip that for you here. I'm going to give you the answer right away to investing. And the secret to investing is a combination of two words. Very simple, but I don't know if you'll believe me. We'll see. Secret to investing is, well, I'll tell you what it's not. It's not investing everything in GameStop. And it's also not investing everything in Bitcoin or crypto. I think that could lead you astray. But if you put some of the kind of noise and some of the recent headlines in the past couple of years out there, the secret to investing is actually pretty simple. The two words to remember: be average. So this is probably the most counterintuitive thing you'll hear during this series. It's probably the most counterintuitive thing you'll hear during your Harvard tenure. None of you got to Harvard by aiming for average or being average. Your parents never told you aim for mediocrity. If anything, like you are aiming to be above average. But the paradox that I want to kind of talk you through is that when it comes to investing, aiming for average actually gets you above average results. So let me start with a story, and I'm going to come back to Warren Buffett here, and then we'll talk about what average actually means. So Warren Buffett, is legendary investor, but what he says publicly all the time is that for 99% of Americans, they should be investing in what he calls index funds, plain vanilla index funds, which really are just trying to track the market, as opposed to giving money to a hedge fund or someone who's actively trying to beat it. Now, those index funds are the purest form of average. Their goal is really to just track the market and be average. And Warren Buffett said, I believe in this so strongly, I'm going to put my money where my mouth is. And I will bet any counterparty, anybody else or any firm, $1 million that my average plain vanilla index fund investments will outperform whatever you want to invest in. One hedge fund, Protege Partners, took him up on this. They bet $1 million, and it was a win-win because the $1 million went to the winner's charity. And you probably already know where the story is going, but let me give you the results. Oops, there we go. Yep. It was a 10-year time horizon, and Warren Buffett invested in the S&P 500 index fund, the most average of average investments. And Protege invested in 5 different hedge funds. And you can see that after 10 years, Warren Buffett earned about 125% return on his investment, whereas Protege earned 36%, maybe not quite a quarter or third, a little bit in between. And so his average investments greatly outperformed what expert stock pickers, invested in. Again, the paradox of average. Aiming for average actually gets you above average returns. So if you take nothing else from, the next hour, it's aim for average. So now let's start talking about what that means when it actually comes to investing. So first of all, I want to talk about why investing is critical. You over the course of your life are going to want to build short and long-term wealth. And investing in the stock market is really the best way of doing that, and doing it in kind of an appropriate way. The reason for that is that a lot of other vehicles can help you build wealth and actually help to reduce risk, but they're not going to generate the same types of returns as investing in the stock market. So the average savings rate, when you adjust for inflation over the past, kind of 100 years or so, has been pretty nominal. Now, again, you might look and say, oh, I can actually go to a credit union or a bank or another institution, and actually they're telling me I'm going to earn, 4% or 5% on my savings. That's true, but then when you actually subtract out the inflation rate, you get down to much lower rates. Same thing with bonds and others. So stocks are historically the one that have outperformed inflation by a great amount. And you can see that, at least for the 100-year time period ending in 2014, it's been about 8%. There's some, thought that overall return will be lower, going forward, but still in kind of a 5, 6, 7% range. And, what does this mean? Essentially, if you had invested $1,000 in, stocks in 1914, you would have $2.3 million in 2024. If you had invested that $1,000 in bonds, you'd have $3,000, 3 times your money. While $3,000 is great, $2.3 million, quite a little bit better. So let me give you, just an example, an illustrative example of why this works and how it works. And I want to illustrate a concept from this. So imagine you're, walking down, walking through a Harvard yard, and you notice a penny on the ground. And it's a magical penny because it doubles in value every single day. And so, on day 2, you have 2 cents, day 3, you have 4 cents, 8 cents, 16 cents, etc. How much money do you think you'd have on day 31? Any guesses? Feel free to put it in the Q&A. I know some of you are math whizzes. You're either doing this in your head or, on your phone or in Excel. But take a guess. I've heard tremendous variation in guesses here. So, think at least in your head of a number, and may surprise you. I think usually it surprises a lot of people that on day 31, your 1 penny grows to be $10.7 million. It's a huge sum. Now imagine, you're walking through Harvard Yard, you're too busy, texting your friend, posting something on social media, calling your parents. Don't forget to do that. And you and you miss the penny on the first day, and you only get it on day 2. How much money do you think you'd have at the end of that same 31-day time period? The answer, yeah, you'd actually have half, call it $4 million. And if you missed the penny on the first 9 days and only got it on day 10, now you actually have only $21,000. So what's going on here? Well, the title of the slide illustrates the concept, and we call it the time value of money. Essentially, your money starts to grow exponentially because it compounds on itself. And we call this kind of the power of compound interest. And essentially, what it means is that little amounts, like as little as a penny, can quickly add up if you give yourself enough time. And what you'll notice is that if you start on day 1 as opposed to day 2, you end up with twice as much money because you basically have one extra time period for that money to double. And so look, from an absolute dollar perspective, or I would say this, relatively your money's doubling every single day. And so, but if you look, let's say, take the day 1 example, doubling, let's say from day 7 to day 8, you're making 64 cents, or, from day 8 to 9, you're making $1.28. That's money and you're doubling. But from an absolute dollar perspective, these last doublings are the ones that really matter the most. That's when you're starting to earn, $2.5 million, $5 million with every doubling. But in order to give yourself the opportunity for those doublings to happen later on, you have to start early. And one of the points that I want to make, especially when it comes to investing, or especially investing for retirement, is that one of the biggest things and biggest advantages that you have is that time is on your side. And especially right after graduation, the sooner you can start to invest for your longer term security, like retirement, the more opportunity you'll have for your money to double. And the flip side is that waiting, and in this case, waiting 10 days, or the equivalent would be maybe waiting 10 years, can actually have drastic consequences on how many time periods you have to double. So remember that, in addition to how much you're putting in, there's also a notion of how long you have to invest that really, really matters. Now, I want to go back to my objectivity point. Here in this example, your money is doubling every single day. What I would say is, if anybody's promising to double your money every single day, or frankly, even every year, you should take that not even with a grain of salt, but a huge mountain of salt. Hasn't been, possible to do on a consistent basis over time. Real returns, as you saw in the stock market, on average are 8%. There are years where you get into, double-digit percent. Last year, the S&P returned 23, 24%, but 100% year in, year out, not happening. So key takeaway number one, it's not only about saving consistently or putting a lot in, but it's about the earlier you can start saving and investing, the better off you'll be. So let's start getting into some of the mechanics of investing and how you actually go about doing that and building a portfolio. So look, first thing I want to acknowledge is there's been a lot of whiplash over the past couple of years in terms of the headlines and volatility that we've seen in the stock market. In 2022, you saw headlines like the ones on the left. The Fed was raising interest rates. There was fear that the U.S. economy would go into a recession, and you actually saw the stock market plunge to new lows and potentially enter into a bear market. This year, or this past year in 2023, people are saying, "Hey, where is this recession?" And actually, as I mentioned, the S&P, bounced back and actually hit a new high. And so there's a lot of volatility that's been happening in the stock market, and that's fed by, inflation, changing interest rates, frankly, war that's expanded in the world. All of that creates volatility. And there's ways to take advantage of that, and also things you want to do to protect yourself with that volatility. So a couple of the themes that we'll be getting into is, one, some advice I have around what to do even before you start investing, some key terms, and some key ways to think about, how much risk you want to take on. And then let's think a little bit about whether you want to do this alone or whether you want help. So look, investing is probably, it's the sexy thing to do, right? You want to kind of open up a portfolio, you want to kind of, buy stocks. Before you, start doing that, I actually recommend doing a few other things. One is building up an emergency fund, which I think of as the stuff happens fund. And especially, you can even start this while you're in school. Definitely once you graduate, you want to have money on the side that in case there's a financial shock, whether it's a job loss, whether it's, a big healthcare expense, something else, you have money that you can use to pay that off, as opposed to resorting to loans or kind of high interest debt. Other items I would say is making sure that you pay off any high interest debt that you have, like credit cards. Yes, like on average, you can earn about 8% a year in the stock market. But if you're not paying off your credit card in full every month, you are actually paying probably 15, if not up to 24% in interest on that, which is actually more than you would earn in the market. Finally, and this is going to be true, especially as many of you start working, and as I talked about before you start general investing, you want to think about contributing and investing in your retirement account. So some things that you definitely want to think about before you even really broach the topic of investing. When you talk about investing, I think there's some key terms that are important to talk about. So one is something you may be more familiar with, which are checking or savings accounts, where you put money in up to the FDIC insurance limit. It's protected, and you can even earn interest on that. Then you get into, kind of money market accounts or certificates of deposit, which, may carry slightly more risk, but are still really safe. And then you talk about things, and we'll talk about things like bonds, stocks, and mutual funds. So a bond is really a loan that you end up making to a company or the government. It's essentially an IOU. And at the end of the term of that bond, you usually get your money back plus, kind of in some kind of stated interest. Stocks, otherwise known as equities, are not IOUs. They actually give you ownership in a company. So if you own a share of Apple, you actually own a portion of Apple. It is a really small piece of it, but you actually own a piece of the company. And the way you make money is that if the stock price goes up and the company appreciates in value, your share is worth more. There are also companies that actually give out dividend payments, which are almost the equivalent of kind of an interest payment every single year. And then mutual funds are really just a bundling or a collection of stocks, or it could be a collection of bonds that you can invest in instead of having to pick individual bonds or stocks. So just to make sure we're kind of all on the same page here with that terminology. The reason those are important is that you can take each of those, and I think of those as almost like the term that I use as asset classes, and you can think of them on a continuum of risk. Checking accounts, money market accounts carry very little, if any, risk. Bonds, a little bit more. Stocks carry substantially more risk. If you had invested in companies like Enron, your stocks would be worth zero at that point because the company went bankrupt. And by the way, there are things that are even to the right of these, like cryptocurrency, for example. And so you have to understand that each of these carry a different amount of risk. And that's okay, because what you want to do is basically think about that risk compared to the time horizon that you're investing in. And the rule of thumb is the shorter the time horizon you have until you need the money, the less risk you should take on. Conversely, the longer the time horizon, the more risk you can afford to take. And we'll walk through why that is. And so when you think about investing, one of the first questions that you should be asking, or that somebody will ask you, is, what are you investing for? For example, let's say you're a junior and you're thinking about going to grad school, and right after you graduate, and you want to save money for tuition in grad school. You have what I would call a very short time horizon, about a couple of years. And therefore, what I would say is you don't want to take too much risk with the money that you need for tuition. And you should think about, ideally using some of these lower risk options. If you're saving for retirement, which is probably 30, 40 years away, that is a very long time horizon. And I would say you can afford right now to take a lot of risk. And therefore, I would recommend, and we'll talk about how to do this, investing much more in stock and bond-based mutual funds. So there's a very important connection between the risk of certain investment options and the time horizon that you have. Let me give you a reason of why that time horizon matters. So if you look, let's say, I think the time period here is 1950 to 1994, but it really holds over other time periods. And if you invested $1,000 in stocks and you looked over that, call it 50-year time frame, and said, okay, what was the most money I could have made in 1 year? Well, the best performing year in that kind of 50-year time range, actually, market went up over 50%. And so you would have $1,500. Amazing. But the worst performing year actually was down 27%. And so if you needed money in a year's time, yes, you could have made, $530, but you could have also lost, a quarter of the money that you needed, which, depending on what you needed it for, could actually impact you quite substantially. Let's look at a longer time horizon, though. Imagine you invested that $1,000, and now let's look at a 25-year time period. And we look at every 25-year time period. So like 1950 to 1975, 1960 to 1985, et cetera. Over the course of, if you take any of those 25-year timeframes, the best 25-year period, you would have made 11% every single year on your money. here's the really funny part, or the interesting part, which is in the worst 25-year time frame, you would have made 8%. Sounds a little bit better. Yes, I would have loved to make 11% a year, but if the downside or the worst I'm going to do is make 8%, I'm feeling a little bit better. So here's a graphical representation of that. And this shows you, starting on the left is the example we had at first, which was, the range over a 1-year time frame. All the way on the right, you see the range for a 25-year time frame. And then you see some in between. Two things are happening here as the time frame extends. One is the delta from the best outcome to the worst outcome starts to shrink. In a 1-year, time frame, the gap was, what is it? It's about 79 percentage points. And we get to 15 years, you take 16, minus 4, your gap is only 12%. And then obviously in the 25-year time frame, you're only looking at a 3%, gap. So one is your range of outcomes starts to shrink. Number two, your worst outcome starts to look a lot better. In a 1 or 5-year time frame, you might lose money, but as you get to 10 and beyond, you're actually making money. And yes, on a 10-year time frame, I'd rather make 17 than 1%, but at least you're making a little bit of money. And so the longer the time horizon you have, the more time you have for some of the volatility that we've seen even the last couple of years to smooth out. And over the long run, stocks return about 8% a year. And so that's where you see kind of that 7.9, number come from. And so if you have the time and you're investing for something longer term, you can afford to wait for some of these kind of outcomes to happen and for things to kind of smooth out a little bit. So just a kind of a concept that's important to remember. And again, the key point is you want to link the assets or the risk that you're taking with the time horizon. Now, a question I often get is, okay, I'm convinced I want to kind of open an account. Like, where do I go and what do I do? There are a lot of great options, and obviously I can't put them all even on one slide, but a couple that you may want to consider. One is there are some really large blue chip investment management companies like Vanguard and Fidelity. Fidelity is actually Boston-based, that have been around for a while, are known for offering those average investments, very low cost, mutual funds that would be great options. You see some other options even on the left that are for consideration. And we'll talk a little bit more about, if you want to do it alone or get advice, but some other options for you to consider are robo-advisors. Robo-advisors like Betterment or Wealthfront, there's many other options, essentially are in between kind of doing it alone and working with kind of a human financial advisor. They use AI to kind of automate the process. You answer a few questions and they help you kind of create a portfolio. Betterment, as one example, and I think Wealthfront and others, actually leverage a lot of these average low-cost mutual funds from Vanguard and others in opening up an account, in kind of investing. So you're kind of getting the best of both worlds. One caveat that I'll have on this, and again, I try not to take a strong position, is I'm not the biggest fan of Robinhood. I think it's a good entry into investing, but I think they've also gamified it to the point where it might encourage you to invest beyond what you can, and also gives access and sometimes encourages you to kind of use some more esoteric instruments like derivatives, like puts, calls, like things that really like most investors don't necessarily need. And it's I think maybe not the best option for to consider. So I don't take a strong position, but a little bit of my word of caution there. So going back to kind of the start of kind of the average point. So what does that actually mean? Well, there are collections of bonds and stocks which come in the form of mutual funds, or there's other options now called ETFs, exchange traded funds. What I love about these is that they automatically diversify you. You don't have to go and pick individual stocks or bonds. Doesn't require as much research. Really convenient, and ones that are average, what I mean is index funds, passive ones, have very low costs. Individual stocks are riskier. They require a lot more research and attention. And, I think there could be in some ways more exciting, but my recommendation for all of you would be to focus all, if not the majority of your investing dollars in low cost average mutual funds and ETFs. If you want to try to play the stock market, carve out a small portion of what you have, go for it. Pick individual stocks and kind of do that. Just know that it's a big gamble, and I wouldn't over kind of index on that. So when you think about mutual funds, and if I've convinced you so far, what do you want to look for in a mutual fund? Well, there's two types. There's what are called index funds, and there are things called actively managed funds. Index funds essentially try to track a stock market index, which you may have heard of as like the S&P 500, the Dow Jones, the NASDAQ. Because they're passive, you don't actually have to pick individual stocks. And because they're just trying to track a market, they tend to be very low cost and are easy for you to invest in by opening up an account. Actively managed funds are where you have a human or a set of human people who are trying to beat the market. And they are making trades, buying and selling, doing a lot of research to try to outperform the market. Because you have more humans involved, they tend to cost more. And there are sometimes hidden fees that are in there. My recommendation again, and this goes back to the Warren Buffett and protege example, focus on index funds as the core, if not all of your portfolio. Aiming for average gets you to be above average. Let me give you some data, and then I'll turn it over to somebody much funnier than me to give you another view on this. This was in the New York Times. You see the link at the bottom if you want, but this was research that was done starting in 2010, and basically looked at the top quartile of actively managed funds. And you can see that was over 2,800. And they looked at how many of those stayed in the best performing kind of quartile over 5 years. And over a 5-year time frame, only 2 were consistently in the top. And so look, outperforming the market in many ways is like flipping a coin. If each of us flipped a coin 100 times, or maybe if the entire student body did, you could very well find 1 or 2 people who flipped heads 100 times straight. Would you be willing to bet on that person that on their 101st flip they would kind of land heads? Or is it frankly just luck and probability that you get that? The main findings you see at the bottom, which is very few actively managed funds are able to consistently outperform the market. And what I find really interesting is that there was a high likelihood of some of the best performing funds 1 year every 2 years, they actually became the worst performing funds in the following years. And so again, my advice, stay away from the actively managed funds and focus in on average index funds. So I'll turn it over to John Oliver to give you maybe reinforce that message in a slightly different way.
Interest works both ways, meaning while your money adds up, your fees can really add up too.
Assume you're invested in a fund that is earning a annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. You've lost almost 2/3 of what you would have had.
2/3 of what you would have had is gone. So think of fees like termites. They're tiny, they're barely noticeable, and they can eat away your future. And one place where your 401k can be full of termites is the funds themselves. Generally speaking, you can choose between low fee index funds, which basically just try to match the average returns of the stock market, or for a higher fee, you can get an actively managed fund with experts who will pick and choose stocks for you, trying to beat the market. And companies that sell active funds really believe in themselves.
Hey, Shahar, we started with the sound. Now the sound not so good. Not sure what's up.
Ooh. Is that any better? Or no?
No, it's we can't hear it, unfortunately.
Okay, let me try one thing really quickly, and if not, we'll share the link, of course, for this. Okay. One more time. Let me dial back a little bit. Oops, where do we go? Let's try over here. Just give me a yes or no on this.
fees, the green line is staggering. You've
think that's
lost
better.
almost 2/3 of what you would have
Sounds
had.
good.
2/3 of what you would have had is gone. So think of fees like termites. They're tiny, they're barely noticeable, and they can eat away your f***ing future. And one place where your 401k can be full of termites is the funds themselves. Generally speaking, you can choose between low-fee index funds, which basically just try to match the average returns of the stock market, or for a higher fee, you can get an actively managed fund with experts who will pick and choose stocks for you, trying to beat the market. And companies that sell active funds really believe in themselves.
At MFS Investment Management, we believe active management can protect capital long term. Active management can take calculated risks. Active management can seek to outperform. Because active investment management isn't reactive, it's active.
Okay. That's not so much a coherent commercial as it is a drinking game where you do a shot every time he says the word active. But the problem with active management is that even many Wall Street experts find it difficult to consistently beat the market. And there is sometimes embarrassing evidence of this, like when a group of professionals were pitted in a stock-picking challenge against a cat named Orlando.
Orlando's method, he throws a toy mouse at a grid of companies. Very scientific. Last year, Orlando's picks returned nearly 11%, while the pros had gained just 3.5%.
Oh, my God! Let's all agree that The Wolf of Wall Street would have been way better starring that cat.
All right. So always good to add in. Apologies for the sound issue, but always good to get a slightly different perspective. As I mentioned, someone a little bit funnier. So hopefully reinforcing the message that we've been kind of talking through. So look, I think where I want to kind of end is a little bit on whether you invest alone or how do you go about kind of doing this kind of with others. And let me just oops, that sharing stopped. Okay. Yeah, and so we'll kind of end on this, and then I'll give a couple options for questions. So if you go it kind of with the help from somebody else, what I want you to remember is one key word, and that word is fiduciary. So you go back to this objectivity, conflict of interest point. This is more about a legal term, but a fiduciary duty means that the person giving you advice has a legal obligation to put your best interests first. It is the best way to maximize the odds of getting as conflict-free advice as you can. And so if you are going to work with any type of, kind of financial advisor, first question I would have is, are you a fiduciary, and do you have a fiduciary duty to me? My strong recommendation, this is the one place where I will come with a very strong recommendation, is that you limit the financial advisors that you work with to those who are fiduciaries. This is not guaranteed that you're going to get, the best advice. There are some, notable cases where people who were fiduciaries, ended up, you've seen with like Ponzi schemes or others, but it is the best way to protect yourself in that sense. And you have a couple options, right? The spectrum that I think of is like do it alone, get help from a human. And in the middle is kind of those robo-advisors that we talked about, like Betterment or Wealth Front, which, provide some guidance, come at some cost, but, maybe not as much as others. The reason I think this is so important, I'll use, data to help illustrate, is that for non-fiduciaries, sometimes there's conflicts in terms of the investment advice that they have. This was a report from 25 from the Council of Economic Advisors, and they looked at the effects of conflicted investment advice on retirement savings. What they found is that that conflicted advice led to suboptimal recommendations, which cost Americans about $15 billion or more in a given year. And the reason this happens is for those who don't have a fiduciary duty or held to a lower standard, they're allowed to actually consider other, other things in there. And so let me give you maybe a case that's a bit more hyperbole, but has also happened, which is, a company is trying to push specific, actively managed funds, and they say, hey, they go to all their advisors, hey, whoever manages to get the most money into these funds is going to win a trip, to the Caribbean at the end of the year. At that point, the person, pitching you on those funds is, thinking about your needs, but in the back of their mind, they're probably also thinking of themselves, sitting by the beach in, some tropical island. And it could lead to conflicted advice in terms of them pushing something, onto you that may not be in your best interest. And so looking and working with fiduciaries, best way to mitigate the downside of this. Often when I do this, we're starting kind of a little bit theoretical and we get a bit more practical, but a question that often comes up is, okay, great. Like you've sold me on passive funds, index funds and kind of to, where to open up an account, but like, what should I actually, like what kind of, mutual funds do I actually invest in? And so here's a sample portfolio that you may find. And when you go to any of these companies, not the robo-advisors, but, Vanguard or Fidelity or Charles Schwab, you'll find that there's mutual funds across many different categories. You'll find that there are some that are focused on small companies, some that are focused on large companies, some that are US focused, some that are international focused. There's different dimensions on this. I would say the most important ones, once you're focusing on index ones, you probably want to think about distributing between small and large companies, as well as, some distribution between US and international. And so this is a sample portfolio, somebody who's, let's say, investing for retirement. 40% of the money is going into large company US mutual funds, 20% into the US small. And then there's a split, on the international side between developed economies and emerging economies. And then there's 10% other. Maybe that's money that's sitting in cash, maybe it's something else. What you'll find though is that there is no consensus on what is the right or correct portfolio, and even how many different, asset classes to invest in. These are all like really, respected sources. And you can see that they differ in the number of, kind of asset classes that they're looking into and what they're doing. A random walk down Wall Street, which I'll reference in a little bit at the bottom left, saying, hey, you only need three things: a total US, index fund, total international fund, and what's called a REIT, which is a real estate investment trust, which gives you a little bit of exposure to what's happening in the real estate market. Others, like you see a little bit to the right, it looks like a really colorful wheel with a lot of other, kind of asset classes. There is no right answer, and you can go with as few or as many as you want. To get even more tactical, and again, this is meant as an illustrative, guide. This is not, advice to go and replicate this. But if you wanted to open up, and this is again thinking about, kind of a retirement portfolio. If you wanted to open up, kind of an account and you only wanted 3 different mutual funds to invest in, maybe following a little bit of, kind of this random walk down Wall Street, maybe it's 55% in US, 35 international, and 10% in bonds. And you could build that portfolio at, Vanguard or at Fidelity or at any others. And just because I want to take you all the way into very tactical, if you wanted to build this portfolio with Vanguard, I laid out the names and essentially the ticker symbols, which, for mutual funds are usually 5, kind of 5 letters, that you could actually go. And if you opened up a Vanguard account, you could search for those 3 different funds and actually put your money in to create this portfolio. You could do the same thing with Vanguard, do the same thing with others. Again, this is not the right portfolio. It's meant to be an example, but shows you how we go from the theory of, okay, index funds, mutual funds, open up a portfolio. In this case, we're aligning the risk for long-term. And that's why you see very heavy distribution towards stocks, which are riskier because your time horizon is, let's say 30, 40 years. And then, okay, great. I want to do that. What are the actual mutual funds that I would go and invest in? So hopefully that brings us, as close to full circle in a very short amount of time as we can. So again, let's say you were going to Vanguard, and again, you have many options. You'd go to their website, and again, this is from a few years ago. The user interface may be a little bit different now, but essentially you would go to their personal investing site and you would look to open an account. And then you would have to decide, are you opening a general investing account or maybe a retirement account? You would select that. And then they would basically, they would guide you down the path to both put money in, as well as, to pick the mutual funds, like the ones I was showing you as an example before. Now, I want to use robo-advisors as an example and a little bit of a capstone to bring together some of the concepts that we've been talking about. So this is an example from Betterment. Again, many other options. If you open an account with Betterment, one of the first things they'll ask you to do is select a goal or an account type. And this is meant to kind of answer that question, what are you investing for? Is it for retirement? Is it for a major purchase? Things of that kind. Once you know the goal, they'll ask you questions around, okay, how much do you want to save? And, how long do you want to save for? Which is essentially the time horizon, if you think about it. And based on that, they will recommend a portfolio between stock-based mutual funds, bond-based mutual funds, et cetera. So let's walk through some of these. On the left is what I would call saving for an emergency fund, safety net. And let's say you were targeting, and these amounts are just kind of there as examples. You wanted to create a $10,000 emergency fund over the course of 2 years. Well, as we talked about, it's a relatively short time horizon. You may not want to take any risk, or you only may want to take some risk. And you see that Betterment here is recommending only putting 40% into stock-based mutual funds. You can see as you move to the middle, if let's say you were saving for a down payment on a house in 5 years, their recommendation is take a little bit more risk, which is, start with, close to 50% in stock-based mutual funds. And auto adjust means as you're getting closer to the time horizon, we would try to reduce the risk and actually move away from stock-based mutual funds. On the right, you can see a very long time horizon. Maybe, you're saving for somebody else's education and you want to save, for them, they're maybe somebody who just born, for when they start in 18 years. You can see that you can take a little bit more risk and starts at a 77% allocation and then kind of moves, would auto adjust down. So in general, my approach is ignore some of the volatility in the market, ignore some of the, kind of trendy investment options, set up a investing plan that focuses on low cost average index funds, consistently, kind of purchase more and invest on a, every month or every quarter kind of year basis, allocate, to appropriate asset classes based on your time horizon, and rebalance as you get closer to that target. So I want to kind of we'll leave a few minutes for questions here, but I mentioned Random Walk Down Wall Street, which is one of the most famous investing books that you could find, and it was written by Burton Malkiel. And Peter Coy, who's one of my favorite New York Times columnists, actually interviewed Malkiel 2 years ago, I guess, at this point, or a year and a half, about his book. And you can see the name of the article in the bottom right, The Best 50-Year-Old Investing Advice Money Can Buy. And a quote that Malkiel had in this article is one of my favorites, which is, you see on the left, is, "It is not often in life that the easy thing to do is the smart thing." And what he was referring to was focusing on being average and investing in passive, low-cost index funds. It's the easy way to approach it. And as it turns out, it's actually the smart strategy to take. And so hopefully through, through all of this, you've heard me, pound, the pavement with that message, but hopefully coming from a lot of different sources. So I'll turn to questions in a second, but I did want to give, some suggested resources as we go through. And if this has, piqued your interest in investing, some great books out there. Whether whether you want a book, whether you want a column or website, a blog or a podcast, all of these are great options. One that I love right now, and she just released her book, Vivian Tu, you may know her from TikTok or Instagram as your Rich BFF. She just launched her book, Rich AF. And I love the kind of real take that she kind of brings to investing and personal finance altogether. Guide to Investing and Guide to Retirement. These are written by what are known as kind of Bogleheads. So the founder of Vanguard, his name was John Bogle, and his disciples, who are really fanatics about his investing approach and style, are known as Bogleheads, and they've actually written some books about this as well. A lot of other options out there. If you want to talk to financial advisors, a couple on here, then I'll mention one other one. Again, I would focus on fiduciaries. I would focus on ones that are either kind of fee only, and you see XY Planning Network is a curated approach for that, or NAPFA, or as you'll hear in the next webinar, through the credit union, you'll actually have access to a financial advisor. I love that the HUECU has been able to kind of bring this offering to members. To me, it kind of is a great fit for for kind of getting some initial advice on some of this. And so you'll hear a little bit later from one of those financial advisors, and hopefully that's just a good session to listen to there. So what we'll do now, I think we have a few minutes left. I know there were some questions that came in throughout, and so I'll just address those, and then obviously feel free to add through. If we don't get to them now, you'll be able to, we'll kind of transfer these over to that next webinar. Question came in: when you first start investing, should you invest all your savings at the same time, or slowly start investing money bit by bit? It's a great question. There's no right answer. I would say a couple factors to consider. Look, there's a lot of volatility in the market right now, and what that could lead to is, if you're investing all at the same time, it could lead to outsized losses or gains in the short term. So, for example, if you invest everything right now and the market goes down in the next week or month or longer time frame, you're absorbing those losses right away. Similar, if it goes up, you could make more. So one of the usual strategies, and you'll hear different terms for this, like dollar cost averaging or otherwise, usually recommends spreading out, even if you have a lump sum, like spreading out those investments over a course of a couple months or kind of a year, and doing a little bit at a time. That limits a little bit of the downside if the market happens to drop. It does in kind of the converse way also mitigate a little of the upside, but it's a slightly less risky approach to to taking that lump sum. Question came in: is there a minimum amount to start investing? What fees are associated with opening accounts at places like Fidelity or Vanguard? Great question. So depending on the institution that you're using, they may or may not have minimums. Some of them have minimums, and some of these can be even as high as $1,000 or or more. A lot of these places have options for students that may actually lower the amount that needs to kind of happen. And so you really have to go kind of place by place to understand if there are minimums. The beautiful thing at a lot of places like a Vanguard or a Fidelity is, like, there is no cost to opening an account. What you do pay for, and you'll pay, are essentially fees on the mutual funds that you select. And the fees, that's really the way that those companies will make money. Some of them may charge like account maintenance fees below certain investment amounts, but a lot of times, like, there's relatively easy workarounds around for those. Some of them charge you to get paper statements, but if you go paperless, you get rid of that. So you kind of have to just go and kind of look at each of the sites. On the mutual fund fees, the reason I kind of harp on those is Vanguard and Fidelity is two, and many others, like, they are known for having some of the lowest fee mutual funds that you'll find. And especially on the index funds, like, extremely low fees, meaning that you are not necessarily paying a lot for those funds. And so one of the things when you're looking at index funds and those passive funds, you want to look for ones that have very low fees. That's usually a good predictor of how much you're going to kind of earn. And so no account opening fees, but you do need to look at the fees on specific mutual funds. All right.
Great. And just one other thing I wanted to throw in there is that we here at HUECU and winter session, our webinars are meant for educational purposes only. So that just means that like each individual's like personal situation is going to be different. These are some examples and some great advice from Shahar, but before you like really make any decisions, you should always speak with somebody specific about your individual situation, which is the very first thing we'd want you to do. So just keep that in mind. But thank you all so much for coming to this one. We're going to let Shahar go here, but if you do have any follow-up questions in the chat, we do have a link to our upcoming webinar in about 30 minutes. That is going to be more of a Q&A focused investment presentation as well. So please feel free to join us for that. But thank you again, everyone, for coming. And Shahar, thank you for being here for this. And great as always. Appreciate your help.
Thank you, everyone. Have a great rest of your week.
Thank you. All right. Bye now.